Hey everybody, this is David Skrika. So your editor is such a genius that I got up in the middle of the night. I went to bed early last night. I really couldn't sleep. So then what happened was I did this long video on the markets on why I think there might be a little rally here, all these things, and then I realized what, I wasn't recording it because I paused the recording to get a few things. So anyhow, we're gonna start it now. The good thing was I kind of meandered on a little too long in that last video. So nice thing about doing stuff the second time, especially when it comes to these videos, is you kind of can get what you want to talk about down and then know what you want to talk about. So we're going to talk about everything from crypto to the stock market to etc. Now today's a CPI meeting. Part of the reason I did that with the turned a little more bullish short term or got rid of some short positions. And so my largest short position now is Nvidia after we got out of HCG. Is part of the reason I did that, quite frankly, was because the market loves to rally on the CPI. On the CPI numbers, right? So it's like I was like, well, the CPI is coming up. We're really oversold in the markets, and so we're gonna do this kind of thing, right? I think that we could again bounce on it. Who knows? Maybe the number will come in. I don't think it really matters. Like I think we're going to see higher inflation for a while now. Like these are obviously everything will go with Russia and Ukraine. It's like a big supply shock, et cetera, et cetera. So this is going to last for a little while. And of course, now we're getting into the summer season where, that's when you get more demands for things, for food, energy, et cetera. And, that's going to, exacerbate the situation over the next couple of months here. So I could totally see this was going to happen. And also too, like, quite frankly, we look at some of these puts, like I shorted Ford, like here, I know some people criticize me because I shorted Ford this big down day, but I was like, well, look, Ford has only gone up. If we get a longer term chart of Ford here from, basically 12, 13 to 24 because of the Rivian investment. And I thought Rivian was a bubble. So then you see what happened. So, I'll be looking to add some out of the money puts. And by the way, that's the whole kind of idea I have with these puts, that if we are lucky enough and smart enough to make, 3, 4, 5 times on a put trade, I'll sell. And if I want to be in the same deal, I'll basically just roll them out into out of money puts. So originally, I think I had May 16s on Ford. And part of the reason at the time, 16 was roughly where the 200-day moving average was. So I sold those, and then I have September 14s, and I sold those. And now I'm going to be looking at November 11, 12s after any bounce here. So and I will just do the same position. Like the position might be $2,000, and then the 2,000 whatever goes to 6, 7, 8. Then you sell, and then you just rotate that 2,000, and you're basically just playing with house money, right? And I did the same thing with HEC.to, that here now it's really oversold. I'm hoping that this bounces and we get back in, And then I also did the same thing yesterday. We sold the pen puts. Pens expire next month. They're basically right at 30, right at our price. They'd gone from about 120, 130, I think is where I bought them, to 270, 280. I bought them when the stock was north of 40. And, so I was like, whatever, let's just sell them and move on, And I actually have some good replacements, which we'll talk about in a second. So, like I said, if we go look at the S&P, we're going to I'll look at some short-term stuff here to start. It really looks like to me, like it, I don't think it's going to have as big as rally as these. I think the rallies are going to be smaller and smaller, but yeah, could we rally back up to 4,100, 4,200? Yeah, sure. Why not, right? Let's get the VIX back down to 25 and then go up. And by the way, this is more bear market action in the VIX, where you were seeing, it goes to 30, goes back to the low mid 20s, and then goes back down. And then the market keeps grinding lower as it does this. You can see the S&P here, the VIX is basically in that trading range. The S&P is moving lower, right? And then we also kind of look at, I think bonds are ahead of what the VIX did, or sorry, the market. See, bonds kind of broke that 200-day moving average at the beginning of the year when the market topped. And then you can see these little rallies the whole way up. But basically, the long bond has gone from 150 last November to 112. That's about a 30% decline. And on something like the long bond, which is a very stable asset, or it tends to be a stable asset, that's huge. And look at all these little tiny rallies. And I think that's what we're doing in the stock market now for the next few months. I don't think anything's going to come of this and that. One reason maybe we're getting the rally today is China looks like to loosen some of the lockdowns. Let's look at the Chinese index. Yeah, it looks like I could rally a bit here too. But I don't think this is anything, but now we still have these bottlenecks in supply chain. It's going to take forever to get through this. We know what's happened with COVID with bottlenecks. That's just something that kind of gets decided, So, so I really believe this is going to happen. So, we've seen these big declines in some of these stocks. I'm looking for other stocks. I still got shorts in Apple. I think if you go look at longer term, Apple could bounce again, but I think it's just topping out here. I think the same thing in Tesla. I'll show you some longer term charts to show that. But what I really want to show you is this is why I'm so bearish. I'm going to do a big macro kind of bearish thing on valuation, on indicators, longer term indicators. But I just want to show you right now, and I'll start off with Tesla, and then Apple, then Tesla, then show you markets. So let's go back 10 years and we'll look at the monthly chart. And is Apple topping here? Now it's had a couple of times where it's stalled out, but if we go look at the last 20 years in Apple, where it's been on this incredible run, from under $1 a share, quarter a share, to 154 a share, there's still been these numerous pullbacks to the 50-month moving average. So roughly a 4-year moving average. It happened in 08, 09. It happened in 2012, 2013, 15, 16, 18, and got pretty close to there in 20. So we can see that on average, even in this huge run, Apple has these pullbacks, and a lot of these pullbacks last a long time. 08, 09, lasted, a year and a half. 12, 13, that lasted a year. This lasted a year, this lasted, this was a little shorter, about 6 months. So what we can see, there's been these year-long pullbacks where it, touches that 50 month moving average. And what we can see is if you go look at 09 to 13, that's, 4 years, to 16, that's 3 years, to roughly the beginning of 19, that's another 2.5 to 3 years. And now we're actually, about 3.5 years. So it's 3-4 years too when it does that. So I think that's kind of what's happening. And that's 94 share, 94. Yeah, I don't know how long that will take, but one reason I have these kind of July out of the money puts in Apple, it's kind of one of my punt puts, I call them, or whatever, lottery ticket puts, is if this first phase down is going to happen. And I'm going to show you why I think the first phase down is going to happen. So this is Tesla on the monthly chart. Tesla, to me, more than Apple. We'll get a little shorter term on Tesla here because it hasn't been trading as long. It really looks like more of a topping kind of pattern here on this monthly chart. And I really, I heard that they actually shut down the plant in Shanghai recently. It was only working at 15, 20% capacity. And they did not even mention that in their last earnings. It's actually pretty gross. So Ford, Tesla, Apple, all of these companies that have operations, sales in China, basically kind of brushed off the China thing like it was nothing, when it's really going to affect second quarter very negatively. Whereas, for example, Under Armour, which, the big clothing company, you can see it's down 32% this month, and down from a depressed level, not, it hit its all-time highs basically when it began trading in 2016. And they said that the lockdowns in China and the sales in China were a huge problem. And Adidas, we'll get the, you can see the same thing, huge decline. And they said the same thing. So I guess lockdowns and slowdowns in China only affect clothing companies, not tech companies, right? So that's obviously being sarcastic. So anyhow, what I want to show you is why I'm so bearish. People are like, oh, you're this and that. I really believe we have seen these kind of one in a generation type bull markets. And I'm going to show you why. So I'm going to show you the S&P and the Nasdaq, right? And you can see now I'm going to put them on a linear scale. So you can see the parabolic type move. This does not happen every decade in markets. Now it's amazing. And actually, here's the thing about 08 and even 2000. I'm actually going to go back to 1980. So you can see this. even the 2000 move, which was parabolic in the Nasdaq, wasn't parabolic in the S&P. It was actually just a bull market in the S&P. Same thing in 07 when it was parabolic in the home builders, it wasn't. So all parabolic curves collapse, right? And go look at even 0102 after this huge move in here. Again, then it got back to the 200-month moving average. Just a 200-month moving average is a long time, by the way. It's 15-month moving average. And at the very least, again, look at the corrections of 15, 16, 18, 20. You go back to the 50, month moving average, which, is 3,400 or so, So, and part of the reason too, that's kind of my price target for this first move down, because, and partly is that's the pre-COVID highs, and that might act as support. And partly because I'm going to show you the Nikkei in a second. I really believe that this bubble is most similar to the Nikkei, and the Nikkei's first move down was about 30%. So this is the Nasdaq here. The Nasdaq, I think, can be very similar to this first little move down here in 2000. I will show you that in a second. That was basically about 40%. So 40% on this would be about 9,000 to 10,000 on the Nikkei, on the Nasdaq. So about another 20% lower for here, and it makes sense because 9,700 again, pre-COVID kind of highs. Then I think you could have a good multi-month rally. When you think about it, the time frame is kind of set up for it too, because that happened in the summer back in 2000. Well, maybe we see another summer type rally here because the market tanks over the next 2 months as the Fed does another 100 basis points. And then probably as they approach that second 50, they're like, oh, we're going to just wait and see what happens, blah, blah, blah. Maybe by then the Nasdaq closer to 10,000, the S&P's closer to 3,500. And they're like, oh, there's unstable, things in the markets going on. There's weakness in the markets, and then financial conditions are weakening. And then that's when they kind of take the foot off the accelerator of rate hikes. And then we can see a rally. That's kind of what I'm looking for here, going forward here in the markets in the next few months. So anyhow, that's kind of what I'm looking at. But if we go quickly, I just want to go back to the Nasdaq and show you that, and you can see how parabolic it looked then. So I think we're in this kind of decline. Nothing's gonna be exactly the same. This one's taking longer, but like this only took about March, April, May, 3 months. Obviously, we peaked in January, so this has taken nearly 5 months. But I guess, like I said, nothing's exactly the same. And you can see the intraday low on the Nasdaq was about 50%, 30% lower. What's scary about the whole market was 40% lower. So what's scary about the whole market right now, though, is like I said, like if you go look at the Nasdaq, okay, it was a bubble back then, or look at this is the Dow Jones U.S. Home Building Index. You can see, notice it kind of looks similar to the first move down here that happened in 06, 07. So same thing. This first move was about 50%. That would actually take us lower, even to about 800, 900. And then there was a little bounce here in 06, and then everything fell apart in 07 into 08. But again, notice the parabolic move. The S&P didn't go parabolic in 07. It didn't go parabolic in 2000. But home builders, which were that bubble then in 07, did, and tech stocks did. So this is the Nikkei here. And again, notice that, okay, that Nasdaq too, when I showed you that Nasdaq chart earlier, we'll go back to it here. Notice that bear market was 78% or 70, and the Nasdaq, it took 2.5 years, right? Well, now we're going to go look at the Nikkei, okay? And then, you can see this is what I think is most similar to. You can see this huge blow off in the Nikkei, similar to what we see in the last few years. This is kind of the first decline I'm looking at here. And let's go again in shorter term so we can kind of see this boom bust in the Nikkei in more detail. And you can see that there was this rally here that lasted about a month or two in 1990, that this after the first move down, again, the first move down was about 4 months. We're about 4 or 5 months into this. It was 30%. So I'm looking at I'm basically looking for about, right now we're 16% on the S&P, we're 23% on the Nasdaq. So I'm looking about 30, 40, 30 on the S&P, 40 on the Nasdaq, if I'm correct. And then we can see this move here. Now, the only way we don't get that is if we get something like that happened in 2000, where the S&P goes back to the old highs. But again, I don't think that's going to happen because the S&P is much more parabolic rather than this long rolling top that happened then. But again, you see there, and then the second half of 1990, there was another huge decline. So that's what I'm kind of looking at here, that we're going to see this decline maybe last another month or two. And then we're going to see a rally like happened here in the Nikkei, and then a big bust. And then again, this was the Nikkei was about a 2.5 year bear market. 2 to 2.5 years seems about right when you get these huge bubbles. Like if you go look at commodity prices, the CRB was a bubble in the late 70s into 1980. Again, mid 1982, CRB index fell about 30 to 40%. And then ultimately, actually, after the big rally in 83, 84, fell to new lows in 86. But like gold was the same way. Look at gold and silver quickly here. Again, after it became a bubble, the bear market was about 2.5 years. And then silver the same way after it became like, sorry. After silver became a bubble, you can see that the move lasted about 2.5 years. And this doesn't even show the original. I'm only going back to May. Let's go back to January. And yeah, January, you can see that top near 50. And again, the bubble lasted about 2.5 years. So that's what I'm kind of looking at because of the overvaluation, because of the parabolic nature of this move, because of all the things behind it, low interest rates, ZERP, trillions of dollars printed. I think this is kind of a generational type bubble. And now I'm going to show you a really important chart, maybe more important than all these. So I do think that bonds can rally here, but we're going to show you, this is the 10-year yield. And there's just something different about what's going on today. Notice how this move is way bigger spike. Like we haven't never seen a 75 RSI on interest rates going back, to 1980. Every time it hit 70, rates would go right back down. And like we had these bear markets like 03 to 06, there was nearly a 3-year bear market in bonds, but it was very stable. And when they went from 3 to 5%, up 60% in 3 years. Now we've gone, granted, it's easier to jump hundreds of percent from a low level, but we've gone from 50 basis points to 300 in just 2 years, right? And notice that, like, other than when we went a tiny bit higher, but basically it was a double top, we never really went to higher highs. And again, look at the 200-month moving average. We're always below this going back 30 years, we've gone above it. So I think that after maybe a little bounce here in bonds, we're going to see like legs higher. And part of the reason I think is the Fed is going to be much more restricted in what they can do. I showed you commodity prices. Now in 08, in 2020, commodity prices collapsed. So the Fed could come in and do all this QE because they under the assumption that, inflation was pretty low. Like one reason in the late 90s, the Fed didn't aggressively raise rates, even with like a kind of bubble stock market, was because when the Asian crisis happened, commodity prices collapsed. So inflation stayed low. And it was still the earlier stages of globalization, of China, India, having cheap labor and keeping costs down, et cetera. So that was all of these things, kind of playing a role here. And I just think that on this move here, because of the supply constraints, yeah, I think commodity prices can come down, all this sort of thing. But look, we've seen a huge rally in the US dollar, and which could continue to go higher, maybe in the short to intermediate term. Again, I'm going to show you another chart on that in a second. And that might, but we've seen commodity prices go up, and that's the worst of both worlds for a lot of these countries. So what we can see here with the US dollar now, we can see that we've got this resistance we're at right now, about 104. If we break that 104, let's say we have to break 105. So that would significantly do it. I think we can go back, and I'm not exactly someone who's been a big US dollar bull, but I think it's like almost too late in the game to trade it or something. But I think we could definitely go back to these 01, 02 highs, which would be about 120 on the US dollar, which is like another 15% from current levels. So I think we could definitely see that. And of course, that would be really bad for asset markets of all type. And if the Fed continues to tighten, and remember, Europe's maybe going to do 80, 90 basis points. The Fed might do 100 basis points, in just the next 2 meetings. So the Fed continues to tighten, a lot versus the euro, versus the yen, which are the 2 biggest currencies weighted in the US dollar index. You're going to continue to see this, So, and the Canadian dollar is broken down here recently. Now, maybe there's, There's something wrong in the Canadian dollar, by the way. I'll talk about that for another time, but it just should be a lot higher with oil prices where it is. I think that has a lot to do with the Canadian economy. But anyhow, so I just wanted to show you that. And another thing I wanted to show you here too, we're talking about stocks. I think we're in kind of this move. Like I think the TLT was kind of leading the way. Notice we just had these little bounces, maybe a week or two, and then right back down. So I think that's basically what we're going to see in stocks here going forward. So I'm going to talk about a few stocks. I showed Apple. I'm going to show a few other things in a second. Just quickly go check the futures here again. Yeah, you can see they've strengthened even a bit more now. So yeah, like I said, one reason I got out of some shorts yesterday was, I don't know why, but they love to rally this stuff on the CPI day. Yeah, but the problem is the catch-22, or as I'm a Trailer Park Boys fan. The catch-23 situation, as Ricky would say, is look at oil's up $3.50 today. So they do that, and it's like, well, the market rallies because inflation's weaker than expected, and oil goes right back up. So that's kind of the irony about it. So and one thing that I think that's interesting for the market too is, even though crypto is not something I really care about that much, but we're seeing Bitcoin trying to hold 30,000, which is a really important support level. It was the lows of last year. But the interesting thing in the crypto market is this thing called Terra USD. It was down to as low as 35 cents this morning. So they have these things called stable coins. These coins are linked by algorithms to the dollar. So you got Tether, US dollar. So a lot of times when you want to sell your Bitcoin, you don't want to speculate anymore. You can go to these things. You just sit there until you want to buy something else, right? And it's almost like you're swapping rather than you're selling. You're like swapping Tether for Bitcoin, etc. Now, I'm not like a huge expert on any of this stuff, but this one stablecoin, Terra, has completely collapsed. So anyone who thought that they were just sitting there, in this, like coin that was like, going to be stable, has now lost 50% of their money. And then the actual Terra coin is down 95%. Now, this has a $2.4 billion market cap, and the stable coin has a 7.8. But do the quick math. We're talking roughly a double, and a lot of money's come off of this too. So this was about 20 trillion, I think, at the top. And this other Terra coin is, times 20 was about 50 trillion. So this was 60 trillion or $60 billion market cap. And now they're down to, do the math, 2.4. They're down to about 8 billion. So let's say 10 billion. They've lost 50 billion of their 60 billion. Well, that's like 4% of the Bitcoin market. And a lot of people go, whatever, 4%. But Nvidia, Nvidia actually is 3 or 4% of the market, and Tesla is about 3 or 4% of the total market cap of the market. So if those declines to went down 80, 90%, you would think that's a big deal. You would think Tesla is one of the biggest companies in America. So I'm just trying to say that if you lose 3 or 4% of your market, that's a big deal when something like that happens. To me, it's almost like, I don't know why anyone would be in those stable coins right now. I don't know that much about it. I don't do a lot of crypto stuff. I know some crypto nerds are going to write me arguing with me. But to me, I equate it to this. When Bear Stearns went under in the spring of 2000 or March of 2008, you did not want to be in Goldman Sachs. You did not want to be in Lehman Brothers. You did not want to be in JP Morgan for like another 6 to 12 months minimum. And they all completely collapsed. So I would not want to be in any of these stable coins after one blew up like that. That is just like common sense, So anyhow, this is like Tesla here. Okay, so this is Tesla, and I just want to show you again. I'm going to show you first a monthly chart on this. We'll get a shorter term because Tesla's only been around for about 10 years. To me, the monthly chart really looks like it's topping, and we'll go lower. Now, we have some support here around 750 to 800. Then there's more support about 500 to 600. But again, you can see that a 50-month moving average is about 400. And then if we get the weekly chart of Tesla, you can see that. And again, note that we're below the 50-week moving average. And again, that 200-week moving average is just under 400. So yeah, that looks like it's really topping to me. And again, let's go put all this stuff on a on a linear scale. Again, it looks like a classic, again, parabolic chart, this kind of blow off, and then this failed kind of rally, and then we go lower, here. And then if we also go look at Nvidia, I got some flack for this. People were telling me Nvidia's in everything great. They're in crypto, they're in AI, they do, I think they do servers, they do gaming, they do metaverse. Look, it was trading at 30 times revenues. Okay. That's ridiculous for any stock. And it's still trading at 13 times this year's revenues. And by the way, they have huge exposure to China. They're supposed to do about 33 billion in revenues this year. 7 billion is in China, up from 3.8. They're not doing 7 billion in China with half that economy been locked down for the last 2-3 months. They'll be lucky to be flat. In 2020, they were flat in China year over year, which was one reason, even though Nvidia did come off the lows in 2020, it came off the lows, it went up. You can see Nvidia wasn't some huge parabolic move because the China stuff did not explode. It exploded in 2021. Again, big reason why Nvidia exploded. I think their revenues were up 60 or 70% in China, then. So, and then now they're in everything that's slowing down. Metaverse stocks are blowing up. Which you won't see here because it's down 30%, right now. It's down another 30%, after hours yesterday. These meta stocks, we all know Facebook bounced on earnings, but, Facebook is completely tanks and it's a metaverse stock now. These things are all tanking. So I think this is the ultimate parabolic chart. And if we go on a log scale and go back 20 years, Nvidia in every bear market, the best performing bear market, it only went down like 60%. And every other one in 02, in 2008, 2009, this stock was down 80%. Okay. So that would be right now, like this stock being like $50, So, and again, we go look at those moving averages I'm talking about, the 200-week moving average or the 50-week moving or 50-week monthly average are both around 115, So, and you can see Nvidia during the 18-19 correction actually did touch the, that moving average, So, and even actually you can see because that correction was so quick, you got pretty close to it in 2020 as well. So it could bounce here because I'm expecting a bounce in the market in the short term, part of the reason I got up. So let's look for some new shorts. So I sold Ford, I sold Home Capital Group, I sold Penn. Just quickly look at Penn here. You can see that Penn has had its huge move down. I was shorting it around 50, it's down 40%. It's like, why not, right? You don't go broke taking a profit. And the whole idea of these, I usually do $1,000 to $2,000 positions. And then if I get up to 5-10 grand, it's like boom, or whatever. I get up to 3 to 6 grand, whatever it is, sell it, and then look to put that initial 2 grand to something else. So what I really like right now, two shorts I really like is Churchill Downs. Now we've seen all the gaming stocks are collapsing. I showed you Penn, but they all look like that. So look at Caesars. I'll get shorter term charts because I think now some of these I want to look at the shorter term. You can see Caesars has gone from over 100 to 50. Win, from 130 to 60. Las Vegas Sands. So all gaming stocks have collapsed. I always forget the DraftKings ticker, DK. I used to do DF. So DraftKings here. Part of the reason is there's not really good margins. I'm not going to get into the details. In sports gambling, there's not really good margins in it. And then it's a least profitable form of gambling. And then obviously too, slowdowns, higher costs are going to, stop people from going to casinos probably at some point, et cetera, et cetera. So, but one stock that really hasn't moved down yet, and unfortunately the puts aren't overly liquid, is Churchill Downs. If you look at Churchill Downs here, it kind of looks like it has this topping formation going on. So I'm going to be looking at, I think I saw the December like 170s or 180s or like $14. But like I said, this is not an overly liquid stock on the option side. I'd probably just do one put or something. And then actually it'd probably something I just forget about because you can't really trade this thing. Just be like, it's kind of like I'm short Ross Gerber's thing. about 22s, July 22s, and they're pretty well in the money now. And it was just like, they're not liquid. You can't really trade it at all, but about a handful. And it's like, I'll probably just exercise them in July, and then you can see here Churchill Downs, that's probably the next gambling stock to go. You can see it went to like $60 during the 2020 lockdowns. So you can see that here. And that's probably a good way. And like, it's overvalued, it's high, et cetera, et cetera. Another stock I look at, again, Moody's, we closed out. We did well on this trade, but it's gone down a lot. Maybe it's oversold. So maybe in the next bounce here, Moody's is a good one. Obviously, higher interest rates that I mentioned. If we look at LQD, this is one of the biggest busts we've ever seen in investment grade corporate bonds. Remember, this was my big short trade. I closed this out, but on any bounce, I'm going to want to re-enter this trade. But LQD, HYG, junk bonds, that's terrible for Moody's business, because it means less companies are going to be issuing bonds, more companies are going to be defaulting, et cetera, et cetera. Terrible for them. Anyhow, so I think ultimately that will be, and again, if we go look at the history, I always like looking at historical performance during moves lower. Moody's went from 270 to 160, went down 40%. Moody's, even in 2018, when we had a move up higher, went from 180 to 125, went down 35%. Granted, it is down about 30%, but of course it's much more, overvalued now. And I think we're in this kind of shift, like I said, longer term, secular thing in rates. So let's put Moody's again on a linear chart, and we can see just, again, another parabolic curve, and look at 07, 08, when Moody's went from like 60, 70 to like, $20 a share, went down 60, 70%. So that's kind of what I'm expecting here. I don't even think these rating agencies should be allowed to be trading publicly, but anyhow, that is for another time. So I kind of like re-entering Moody's on strength, Churchill Downs, kind of re-entering, these kind of positions. And again, like stuff maybe like Ford, I would probably maybe do some November 11 or 12s. Anyhow, so I've showed you the parabolic curves. I want to finish this off now. I've showed you these stocks. I've shown you, the VIX. We'll look at the VIX here for a second. The VIX here, the way that keeps bumping up like this, kind of reminds me of 07, 08. And we're going to see a big spike. We're going to see a panic again to this 50, 60 area. Even like what happened in 2015 or 2018, I think we're going to see that. I don't think this decline is ending with here. I think probably, and that could happen over the next few months. And that could, basically be the ultimate bottom for this move, kind of like that first move down in the Nikkei. But I think that's what we're going to see here. But if we look at the shorter term VIX, look at it, it's really changed the way it's trading here. It's trading more like in a bear market. Note that the VIX, 30, 35, there's these rallies in the market, but notice these rallies keep going lower. The market keeps going lower. So I think that too, you look at this, easily the S&P can get to 41, 4,200. It's not a big deal anyhow. It's 2.5 to 5%. And then you can look to add shorts. And I'm going to leave it at that because I am really tired. It's 5:20. I've been up since like 3 in the morning. I'm going to upload this to my site, and I really hope and I'm going to do more of these. The next video I'm going to do is like the long-term valuations, and I will do one on gold and precious metals. But I just want to show you one reason that I did, talk about long-term charts. Oh, this will be the last one I do. I did do so much shorting was, look, I just remember being around in 08, and I remember being around 2020, and I knew that gold stocks would probably move lower as the market became more liquid. So that's why I wanted to short, because I knew that was probably gonna be the best opportunity for a window. And by the way, it's not like I enjoy the fucking puts. It's, excuse my language, it's stressful. A lot of times one reason I got up so early is I went to bed at like 10 o'clock because it's stressful. It wears you out. One reason you don't see as many updates, longer term updates like this is because mentally I'm kind of drained after trading them, but you can make money doing it. And it was like the only way to kind of make money in the short term. And there is something, there is some adrenaline you get with it as well. But, anyhow, I do think that the market, another thing with Nvidia is, remember, I did hedge our position too. Again, it's so is done. I could see another little bounce here to maybe the 200 range. That's why I bought the June 210s. and then we'll see what happens. You know, and I did sell some and put some further out too. So anyhow, I'm gonna leave it there, and we're gonna see what happens here. But like I said, I'm looking for a short-term bounce in the market, not a big one. You know, week two at the most. You know, maybe just a few days. Like I said, they're ramping the market up into the CPI. They always love to do this for some reason. Um, you know, and um, and this is what I mean. Like these people are just pumping these. Like that's not going to happen at the bottom of a bear market. You know, oh, Kramer says leaving the market's a mistake. No, I'm really bearish. Yeah, yeah, and like I said, yeah, like, anyhow, some of these, like these things are all. Who cares about these things anyhow? Yeah, that's all I'm going to talk about. I think that's about enough for now. And we'll look at some stuff. Like I said, the next one I'll talk about the long-term big picture. I'll show some more of these, maybe these charts, these long-term bubble charts, how overvalued the market is, and then we'll also look at gold and precious metal stocks. Then I'll look at some junior stocks I like, etc. You know.